I want to thank our attendees for being here on our first Marion Street Capital Huddle of 2023 that we titled Seed Investing Outside of VC Hubs. My name is Andres Guevara. I am an analyst at Marion Street Capital, and I will be the moderator today with the lineup of amazing panelists that we have. So we are, Marion Street Capital is a company that helps companies, innovative growth companies, solve their most pressing challenges by offering a combination of 5 services critical to a company's success. FinOps, Data Ops, RevOps, HR Ops, Special Ops, which is basically a management consulting approach of fixing anything that's broken for a company. And so I want to encourage our audience, first of all, to start sending your questions on the Q&A box. We're going to get the last 10, 15 minutes of the conversation. Are going to be yours. You're going to be able to ask questions, and our expert panelists are going to answer them. So why the topic of seed investing outside of venture capital hubs? Well, Marion Street Capital works with companies across the United States and internationally as well. And we see evidence that companies that are established outside of known venture capital hubs tend to have a more challenging fundraising experience than companies that are located in New York, in broader California, and then in Boston. So for this discussion, we invited 3 venture capital experts and investors that focus specifically on companies that are not located in venture capital hubs. They will share their perspectives, their expected trends for the next year, and then their decision, why they made their decision to promote businesses that are not located outside of VC hubs. I want to ask our panelists to begin introducing yourselves. Why don't we go with Scott, and then Drew, and then John? Why don't you introduce yourselves, where you are based geographically, and then the investment focus for Comeback Capital and your preferred industry?
Yeah, so I'm Scott Shane. I'm the managing partner of Comeback Capital. My primary location is in Cleveland, Ohio. We have 3 other general partners, one in Chicago, one in Flint, Michigan, and one in Austin, Texas. We invest in primarily pre-seed and some seed stage companies. All the portfolio companies we invest in have to be located outside of Silicon Valley, out San Francisco, New York City, or Boston. The focus is largely on software and software-enabled devices.
Wonderful. Thanks. Drew?
My first trick is going to be managing the mute button. Thanks very much to our fellow panelists and to Marion Street Capital for hosting a great session. It's good to have this education and for us to think about between the coasts, or flyover country, as it's called. I am in Santa Fe, New Mexico. If you haven't been, come on down. We want your tourism dollars. I am the president of New Mexico Angels and also the managing partner of the New Mexico Vintage Fund, which is a microfund affiliated with the Angels. We're a 21-year-old organization. We're an association or a membership-based group, and we look at primarily companies that are in New Mexico, run by New Mexican entrepreneurs, or a company that's really going to benefit the people of our state. As a state that's seen as a low income and a place that's kind of out of the way, we're very supportive of companies that are here or want to be here and want to develop technologies that can, and health innovations that are going to help our fellow citizens. And we want to work collaboratively with other investors because the checks we write are important and early, but they aren't going to be enough for most companies to get to the next stage. So it's not only helping a local ecosystem, but it's also collaborating to make 1 + 1 = 3. Thanks.
Thanks, Drew. John?
Hey, first, thanks for having me on this panel. I feel privileged to be on this panel. So I represent Stout Street Capital, one of the founding partners at Stout Street Capital. We are based in Denver, and we have a very similar thesis to to Scott. Comeback Capital, we don't invest in New York, Boston, or San Francisco. We tend to focus on startups located outside of those core VC ecosystems or ecosystems that are legacy ecosystems. The stage that we tend to focus on is pre-seed and seed stage. I'd say we lean a little bit more on the seed stage than pre-seed. Most of the companies that we are investing in kind of fall into the tech or B2B tech software focused category, but we're also a generalist fund, so we also invest in robotics, we also invest in advanced materials, we also invest in life sciences. But those definitely fall in the 20% category. They're in with your 80-20 rule. I think 80% of our investments are your bread and butter tech, software, B2B. It kind of falls that category, and we can discuss why we do that and why we have that focus, and especially for why kind of drives from where we are investing as well. So as you can see, the type of companies that are located in the middle of the country also tend to be companies that are a little more capital efficient, that are also companies that are a little more bootstrapped and further along than companies in the Valley that are, I would say, more focused towards more, I'd say, burning a lot of capital and focused on the consumer, versus companies that are focused in the middle of the country or more targeting businesses. And yeah, so to a long answer short, we are one of those investors that invest in the middle of the country. We have about 26, we have about 73 companies in our portfolio right now, and we invest in about 26 different states across the country.
Awesome, thanks for the introduction. So as you can see, we have an audience, panel really full of experts, and that are you guys are experts on this specific focus of investing outside of VC hubs. So throughout the discussion, we're going to try to answer the following questions for the audience. First is, what is your process to select companies that are worth investing seed capital into, and how does this differ from VCs that focus on VC hubs? The second one that we're going to try to answer is, do you compete with VC companies and investors located in VC hubs? And if so, what is your competitive advantage against them? The third one is, what are the most attractive features that you are looking for in an early stage company in the current fundraising environment? And we're going to discuss that fundraising environment as well. Another question is, how can early stage companies get in touch with you and get a response? And what are some common red flags? This is for our audience, for the entrepreneurs in our audience. What are some of the most common red flags that you encounter? And then, how do you help scale portfolio companies to expand regionally or nationally? So let's get started with our discussion. So as you introduced earlier, your organizations invest specifically outside of traditional VC hubs, so namely California, New York, Boston, and historically, combined VC allocation outside of these hubs is lower than the three main hubs. Scott, why don't you get us started? What is the motivation behind your organization making this decision?
Well, so we came about as a group of angel investors who were responding to major venture firms like Founders Fund, General Catalyst, GGV, that were looking for an investment model in the middle of the country. It's just, we don't think about this, but early stage companies in the middle of the country are nearly impossible for $1 billion fund located in San Francisco to invest in. The magnitude of the money going in is so small, right? And the size of their funds so large that they would have to decide in a nanosecond whether they would invest in a company. And so they invest in comeback capital, and we deploy their money. So big chunk of our LPs are coastal VC funds themselves or the partners of those funds that are basically looking for deal flow. The second group of our LPs are high net worth individuals located throughout the middle of the country, and they have a different problem. Their problem is that the deal flow in, let's say, Milwaukee is too low to support focusing only on Milwaukee. The deal flow in Detroit is too low to focus just on Detroit. And so what we're doing is aggregating and sharing deals there. So, you know, why do we invest in that part of the country? Because it's actually the purpose of the fund.
Right. That makes sense. So, Drew, why? What is the motivation behind, behind it? And this question is a little bit different for you because you're part of the New Mexico Angels, but what motivated you to help the ecosystem in New Mexico?
Well, I'll answer the question a little differently, but I think if we're here in New Mexico and we're active in our ecosystem, in our community, we have a competitive advantage, which is one of your other questions, right? And we know our community, we're connected with the other investors who are writing checks because our community is so small. There's only 3 million people in all of New Mexico. So there's fewer people in our entire state than there are in some of our large cities, our Phoenix, our Chicago's, our New York's. And so it's just small. And so to be able to address the activity that is here is pretty easy. And someone in Silicon Valley has enough volume around them, their N is high enough that there's no reason for them to reach out further, particularly when the transaction cost of doing so is higher. So there's a disincentive for that behavior. So it's a rational actor, rational player activity. And so we have a specialization, and the specialization is a niche market. If you understand the niche market, you can make informed decisions. And if you make informed decisions, you can support good companies.
Awesome. And then, John, what is the motivation behind Stout Street Capital decision?
Yeah, I mean, for us, I think it was more on the supply demand side. If you look at coastal ecosystems, the demand for capital is high, but also the supply for capital is pretty high. So in terms of middle of the country, the biggest problem is they're still widely underserved. If you look at the number of companies looking to raise capital versus number of companies that are actually getting funded, they're pretty low. And the ecosystems, regardless of how well developed some of the non-coastal ecosystems are, there's still wide gaps in those ecosystems. So I'd say, like, even the well-known ecosystems like Chicago or Denver or Seattle, there are always gaps, right? So you look at the seed stage market, might be well developed. You might have 30 to 40 funds that can write a pre-seed seed stage check. But a lot of times you don't really have Series A or Series B investors, and there may be just 1 or 2 investors who even write Series A or Series B checks. So a lot of times, and also investors do get pigeonholed into, like, hey, I'll just invest in this one sector, or I'll just invest in these companies with these metrics. They might have had a bad experience with one company in their past, and they never invest in that sector forever. So there's a lot of those idiosyncratic behavior that disadvantages companies in the middle of the country, where if you have 1 or 2 investors in that region that say no, you're pretty much like, you don't really have options, right? So what we saw was there's big demand, and also systemically, this chart, I think, is a good example of it. It shows how volatile your coastal ecosystems are, right? Your upward trends are pretty steep, and your downward trends are also pretty steep. So for us, systemically, we looked at non-coastal hubs being fundamentally better for building a portfolio than building a portfolio for Silicon Valley-based companies or New York-based companies. We feel like they're more susceptible to systemic shocks, and SVB was like one of those classic examples where I feel like non-coastal VCs would have benefited in some ways with that fall, right? Because coastal VCs were a lot more exposed, and coastal companies were a lot more exposed too, from a percentage perspective. So systemically, the problems that do exist in coastal markets don't really trickle down to non-coastal middle of the country markets. And for us, we found that as an advantage for Stout Street when we started out to build Stout Street Capital.
And so, just following up on that, so how much stricter are your screening typically? How much stricter are your screening and due diligence processes when you are considering investing, seed investment into startups compared to funds that invest in companies located in VC hubs? Is it stricter, or how does it vary?
It depends on what do you mean by stricter.
Mhm.
I'd say generally speaking, companies that are raising capital in the middle of the country tend to be a little safer from an investor standpoint, purely because, to my earlier point, which I said, they're a little further along. Most of the startup founders are a little more hesitant to go raise capital from VCs in the middle of the country, purely because there's not many people, writing checks. So the availability of capital being low definitely drives founders to be a little more conservative, which also, and there are a lot of reasons why the valuations are slightly lower, the amount of money raised per round is slightly lower, but also the capital efficiency is a lot higher for companies in the middle of the country. So all those factors kind of provide a little bit of tailwind when you're building a portfolio. From an investor standpoint, it's largely beneficial for us to focus in a market which is favorable and also slightly less risky. But the downside for that is with low volatility comes lower range of risk return profile. So you're not really looking at funds that you have one company that gives you a 10x on the fund. You're looking at multiple companies kind of sharing that burden compared to some of the coastal VC funds.
Scott, what is the most important feature that you expect from seed stage companies when they approach you to raise capital?
So I would say I'm going to emphasize the fact that we think about this a little bit differently than other people, and we are much more interested in the pre-seed stage than the seed stage. We think there's several problems, particularly in the non-VC hub parts of the country. One of the problems is that people get themselves onto a wrong trajectory very quickly and never get connected to big money later round investors. So we're very eager to invest very early. And by that, I mean, we almost exclusively are investing in companies that are less than 2 years old, that have probably order of magnitude somewhere between $2,000 and $15,000 a month in revenue, and a handful of companies. Most of the time, they are pre-product market fit. We are looking for primarily a statement that there is a high magnitude problem and a solution that is several orders of magnitude more valuable than an alternative that the customer has, right? That's generally what we're looking for. So when we see companies, what we want to hear is kind of what have you done in the past year and a half since you got started? What's the problem that you're solving? What's the value of the solution? And for us, what is the milestone that several $100,000 to $1 million gets you that sets the business off on another trajectory? Because we're really looking at getting that company from that pre-seed stage to that next round and primarily getting them out of the local financing ecosystem that they're in.
How about for you, Drew? What's the most important feature that you expect?
For us, we really look at teams, and I appreciate my colleagues' answers because I'm in agreement with them. In New Mexico, the further along an organization is in building up not just the solopreneur, right, an individual with a strong idea that they feel passionately about, but building up a true cohort of C-suite folks. In New Mexico, again, as a small state, it's off the beaten path. There's some talents that are in shorter supply, right? Marketing, salespeople, CTOs, and so forth. And so a company showing that they've been able to put the people together to cover all the needs, particularly for its next step or two of growth, is a really good indicator for us of their ability to be successful. One of the other things in due diligence is we only have one way of doing due diligence. It's not easier or harder, Andres, to your earlier question. But getting to know people over time is a tool that we can use. And in the stereotype of the VC world from television and otherwise, you know, the back of the napkin in a bar and then suddenly you have a check. I think all of us on this call know that is, it's not impossible, but that's a rarity. And often it's a pipe dream. And so we have to do a lot of education of our entrepreneurs. To one of my colleagues' points is there aren't as many VCs. And so sometimes people are gun shy or a little slower to get to them, to the VC world. And then also they don't have as much experience engaging with them. If you are a VC and you do this every day, or if this isn't your first rodeo and you've done this 2 or 3 times, you know the patterns a little bit better. You know the syncopation, you know the questions, you know what happens. If this is the first time you've done this, you are by definition at a deficit of information and experience. And so we want to help people along because we don't think it's fair that VCs are able to kind of prey on PREY, that is, on a company just because one has more experience than the other or has more information than the other.
Awesome. Yeah, that's an interesting approach, but I think it's important for every company should care about the team as well. So thanks for your perspective there, Drew. So I want to switch topics to something that has been the news of the month, which is Silicon Valley Bank. So on March 10th, regulators closed Silicon Valley Bank and the FDIC took over its operations. Silicon Valley Bank was one of the least restrictive banks for startups and the 16th largest bank in the United States. John, does the collapse affect startups located outside of the 3 main VC hubs differently than those located in the VC hubs? And how?
I'd say absolutely it does affect everybody because SVB was everywhere, right? So it's not a question of whether somebody was affected. The right question is by how much, right? So in terms of affected, like every VC, I guess everybody in this room probably banked with SVB. I mean, we banked with SVB too as a fund. But the question is, like, who's going to be affected the most, right? And the more, I think the issue with SVB kind of surfaced a lot of systemic issues with the industry and also the practices in it. In general, SVB was definitely a good actor in terms of how they were developing the ecosystem and everything. But on the flip side of it, they were also very exclusive in nature. So they did not bank every single startup that wanted to bank with them. I'm not talking about providing debt, but just banking, right? So for every founder that wanted to bank with SVB, there were 9 others that didn't get to bank with SVB. And the ratios of that were a lot higher, I'd say, in the middle of the country versus some of the coastal hubs just because of how intertwined they were in enmesh, they were, you know, with some of the VC firms, and that was their go-to-market strategy too, right? Working with VC firms and community members, and pretty much servicing their customers or servicing their portfolio companies. And so to a large extent, some of the legacy funds, some of the larger funds, some of the older fund managers definitely had a larger exposure to SVB and its collapse and the risk of its depositors not being made whole. That was a real risk that could have killed some of these older established VC firms, and also would have wiped out a lot of their portfolio companies. And to an extent, if you're thinking about it very strategically, it could have benefited the middle of the country a lot more than the coastal hubs, because this was one of those systemic shocks that definitely impacted them a lot more than us, if you're making that them and us argument. So to that point, yeah, SVB definitely highlighted some of those issues, and hopefully we can learn from it. I mean, VCs definitely have right now what everybody is learning is it does have an image problem, and it needs to be resolved, or else we're gonna get into deeper trouble.
Scott, so with the recent developments, do you see an upcoming shift in the main regions in which venture funds are allocated?
So I don't think that there's a geographic effect that's that large in what happened. I mean, we banked, our funds did not bank with SVB. We had probably 15% of our portfolio banked with them. I think the biggest issue was the more successful the companies we had backed, the more likely they were to have venture debt from Silicon Valley Bank. And I think what people are not paying enough attention to is we have a dual problem right now. Silicon Valley Bank got all the news. The Signature Bank was one of the other big venture debt providers. So you've pulled two big venture debt providers out of the ecosystem across the whole country. And so I think the big effect will be pulling down valuations, making it harder for companies to raise money by sucking debt out of the system and putting more pressure on the equity side, which is already slowed down a bunch. Yes, there's probably some greater effect in downtown San Francisco of this, but man, in Cleveland or in Chicago, it's not so great either.
Drew, so do you see this shift? Do you see any shift occurring in your region and in the companies that you work with?
Well, I think the more interesting factor is a shock like this allows everyone to be a Monday morning quarterback. And what I mean by that is we should all have been following best practices in financial management, right? Just because the bank did it and just because the regulators didn't, doesn't mean that we shouldn't be the smarter bear and work with our company. So for example, you know, $250,000 for FDIC insurance are really easy tools that we can give our companies, seeders in the credit unions, diversified accounts in most banks. And so it doesn't take that much effort. And so what we talked about in our general partners meeting after the Silicon Valley Bank situation, thankfully the government stepped in because they wanted to reduce contagion, and we can argue whether who got benefited from that and whether that was appropriate, but I think it accomplished its goal. And so we talked about, you know, do our entrepreneurs, is there key man life insurance so that the investors are protected, the company is protected in a horrible scenario where the leadership has an unfortunate situation and can't keep leading? Do we have a good bank situation? Have people looked at the treasury management? These are things that every CFO, every finance person should just do just like that. But sometimes in our hectic days, we don't necessarily check off the list because it's further down the list. And so I think the good hygiene, you brush your teeth once, hopefully twice a day, you floss frequently, Why do you do those things? Because you're dentist and you saw the reasons to do so. Even though none of us probably liked flossing, except for maybe your weird Uncle Harry or somebody like that. But you do these things for a reason. And I think it behooves us all to stick to our knitting and do these fundamentals. And then the challenges of the banking system, I think, become less painful to us because we've protected ourselves.
Drew, what should entrepreneurs in our audience expect in the next 12 months as they conduct their capital raising campaigns? And what are some recommendations you have for them?
Yeah, let me give a couple of points briefly, and then we can do follow-up if needed. The next 12 months is going to be some choppy waters. A year ago, we were working with a really good data-driven SaaS startup, and they had great conversations with the VCs. And then suddenly, those of us remember a year ago, interest rates were rocking up. There was a lot of things in the news, and the VCs' attitude changed very, very quickly. And that's reality, right? We can't complain about that because it's reality. What are you going to do? Complain about the weather? So you have to be prudent and you have to be defensive. And so the hockey analogy is you don't skate to where the puck is, you skate to where the puck's going to be, right? And what I mean by that is you need to think ahead. You need to have good financials. You need to be shoring up your financial relationships now. And then depending on the type of company, if it's appropriate, it isn't for all companies, but I encourage people to look at different types of capital. Our colleagues mentioned venture debt and the shockwave of two of our larger suppliers of that being pulled out of the system. But there's a lot of other alternatives. There are non-bank lenders. There's CDFIs, a community development financial institution. If your company is located in an underserved area, there might be an OZ fund, an opportunity zone, or a new market tax credit. There may be revenue-based investing, what's called RBI, which is the idea that once you're in revenues, they can leverage your revenues and your forward cash flows with capital. And then also just our general relationships with banks or other private investors. So I'm not the one to say you always need equity. I would say that you only should do equity if you have to. It's a powerful tool. It's available, but there's other ways to finance programs, and including state, government, and non-dilutive capital. And I think our entrepreneurs should really get to know and use all of these tools available to them. And that would really help both a smoother ride in the next 12 months, but planning for your hockey stick as whatever it looks like for you.
Scott, anything to add there?
Yeah, I mean, the investment market is going to be less founder friendly and less attractive to the founders. We actually operate so differently from most investors that we're actually thinking that it's a good time for this. So first of all, a couple things about our approach. We are 14 days from first meeting to signed documents and wired money. One of the competitive advantages is speed, and we can price down valuation significantly because we're offering entrepreneurs time again. So to be honest, there are fewer people actually writing checks right now, and that is makes it harder for entrepreneurs. Entrepreneurs are not getting multiple term sheets there. People are not bidding there. Second, so a second thing that's very important is that the later rounds of financing have come down more severely than the early rounds, which means that when you're raising money early, during the bubble, we were happy with people who were raising for 12 months, and we think that's now a bad idea, and we want them to raise that first round for 18 months because we don't know that they'll make enough progress to interest the next round of investors. I think the other thing that's just very, very important right now, and I don't think enough people say this, big funds hire lots of analysts. They have a lot of capital under management. People have to look busy. They take meetings because if they don't take meetings, their boss will tell them they're not working. And so I'm urging lots of founders to go to the small emerging manager funds, particularly single GP funds, because those people are not drawing big salaries, and if they don't find investments, they're not going anywhere, and they can't wait 5 years for investments. And I think that's just an important aside of targeting for entrepreneurs. But I'll stop now and let some others comment.
Thanks, Scott. John, anything to add there?
In terms of advice for founders or just a general outlook, I think my fellow panelists covered the general outlook. I mean, I agree with it. It's going to be a difficult environment out there. And yeah, taking the debt providers out there, especially SVB and Signature, does affect, I would say, later stage. I'd say A and B stage companies a lot more than earlier stage companies. That's the only distinction I would make there. For early stage companies, they were not really providing debt anyway, so it wouldn't affect early stage companies. Companies that are raising their pre-seed and seed rounds should not be affected by what happened with SVB or Signature Bank. But in terms of is there why investors are behaving this way, I think psychologically there you need to understand a little better for founders why people are holding back is not because people don't have money or people didn't raise enough money for their funds. Most of the funds are, I'd say, well capitalized, or at least in terms of commitments, there is enough money sitting on the sidelines. Why there's this hesitation to write checks is primarily driven by the expectation, right? The risk reward equation has been kind of reset to a large extent. So a lot of times you don't really know what multiples you're getting into, or like your entry and exit multiples have been reset to Scott's point. So there's a lot of rounds out there which are essentially raising money at your previous valuation, primarily because nobody wants an optics, and nobody wants the optics of a down round. Your existing investors aren't really sure what the multiples for this, whatever sector, again, it depends on the sector, industry, what multiples you're getting. They aren't sure what multiples they're going to get. And the biggest debate right now is who's going to buy them, right? So a lot of the buying, a lot of the acquisition or inorganic growth in the later stages of VC companies kind of happen freely because of kind of a low interest rate environment that fueled, debt providers to kind of capitalize some of these older legacy companies to pretty much go out and aggressively buy a lot of startups, which kind of fuel that exit surge. There's a chart for it, but you'll probably see the growth and exit activity kind of coinciding with that bubble that Scott's talking about. So whenever you see that surge in exit activity, you also see growth and optimism from early stage investors, where early stage investors feel a little more optimistic about their investments, that they're going to get exited. So the downside risk is a little more mitigated, or that's a perception of it, because most of the time you're sitting on 5 to 7 years before any of these companies exit. So perception matters a lot more. And right now it's very pessimistic. The outlook is pessimistic. The exit activity is dropping like a rock. So, and a lot of the companies that were big acquirers are announcing layoffs. They're doing their own cost-cutting measures. So from those perspectives, the exit activity has dropped, which has pretty much had that trickle-down effect into earlier stage investors. But the good news is most of the funds have a 3 to 4 year investment period. Not a lot of them can just sit on it for a long time. So my projection is the lull in early stage activity might be short-lived, or maybe it might last 3 to 4 quarters. I think it started Q3 last year, Q4 last year, where it really took a big impact. But I think Q1, Q2, we're probably going to see more depressed activity. I think once the macroeconomic sentiment settles down a little bit and people know exactly where this economy is going or where interest rates are going, I think there'll be a little more comfort, and I think capital's going to rush back, at least in the earlier stages. In the later stages, we might see some more opportunistic acquisition opportunities occurring as well, which will probably drive up acquisition numbers or acquisition activity as well, which will ultimately trigger.
I think we lost you there for a sec. So there you go. So we can just switching topics here, or along the similar lines. So according to Facebook, during Q1, Q2, and Q3 of 2022, $16.6 billion were invested in angel and seed rounds, over 4,616 deals, while 178 billion were invested in later rounds, over 9,020 deals. So several companies that get funded early on don't raise later rounds of capital. Some of this is by design because they just feel like they don't need more capital, but some of this is because they just can't find follow-on investment. So, John, what are some factors that lead to investors deciding not to continue supporting financially the early stage companies they initially fund?
It depends on the fund strategy. I mean, a lot of the early stage fund managers that we deal with by mandate are single check writers, right? So they have predefined entry points, and the entry points might limit them from follow-on investments. Plus, also, most of your angel checks are fueled by high net worth individuals and not really institutionally driven. So, and if you look at the past, there's a higher correlation with as well. So if you look at if you look at stock market returns for the last year has been depressing, and it continues to be bad, or I think it's stabilizing to a little bit, which I mean, in terms of the wealth effect for for angels is probably one of those driving factors where they don't feel comfortable doing, like, I would rather just put it in a CD, or like I'll cash out and see if I can do better with the stock market, is probably what people are thinking, than investing in venture and waiting for 8 years or 9 years or 10 years to get their money back. So from a short-term perspective, angel activity kind of provides you a little bit of inkling on how people are trading off risks and where they see they want to risk off. So again, like there are papers that talk about angel investment activity and how that's correlated with the stock market indices. That will provide you a better answer for like why that drop off in angel activity kind of coincides with the stock market returns, and that would continue to be the case, and that correlation kind of lost for. I mean, it's been true for the last 30 years, so I think it's gonna stay.
Scott, so in 2021, the distance between lead investors and their target company averaged only 37 miles at the angel and seed stages. This is a significant obstacle for startups that are located in regions with low deal activity. So Scott, are you aware of any initiatives that the broader venture capital industry is undertaking to address this key challenge for promising organizations that may fail due to the state in which they are located?
I mean, that sounds like a policy question, and most investors are interested in making returns for their LPs, so they kind of don't care. I will tell you that the idea that almost all early stage companies need to raise another round of financing if they're pre-seed or seed stage to get to an ultimate exit is kind of why we do what we do. I mean, we have invested probably in 60 companies now. 82% of those companies have raised a subsequent round at a markup, and we take credit for probably a large portion of those introductions that allow that to happen. And it's the networking effect that I think is the biggest role early. For those funds that are located in other places, like the venture capital hubs, they're interested in it at a deal basis, and they don't really care about the companies left behind. And to be honest, we don't know if the companies that don't raise because they weren't good companies and therefore shouldn't be raising, right? Like there's always that as the explanation, not just that they were somehow unfairly treated.
Drew, how about you? Are you aware of any initiatives?
I'm sorry, ask the question one more time for me.
Yeah, are you aware of? Yeah, sure. Are you aware of any initiatives that the broader venture capital industry is undertaking to address the challenge for promising organizations that may fail due to the state in which they are located?
I feel like the question's hitting me a little differently. So with your permission, Andres, one is that at the early level, there's a very, very good tool that's available in 32 states that's called the Angel Tax Credit. And there's a national association. People can find it readily online. New Mexico, it's a very important tool for us. It's 25%. So a qualifying business that is doing most of its activity here in New Mexico, most of its employees, most of its manufacturing, most of its creation, et cetera, can qualify so that if we are investing the veritable $1 million, 250,000 of it would be credited back on their tax liability in the state of New Mexico. Different states have different ways of doing this. Arkansas is one of the more lucrative ones, and so forth. And so I think from a policy perspective, whether your state is doing this, whether Citizen, I'd be very interested for our Cleveland colleague, Steve, what's happening in his state. Pennsylvania, for Philadelphia, for the others on this call. So I think that's a tool, and it's a good tool. The other thing is in New Mexico, the state is a fair partner for startups. We have 3 national labs here, and so there is subsidized money, SBIRs, for those who know what those are, which are research-based. There's also state programming for job creation, which I think is very valid. And so for us collectively to help our startups to navigate these capital sources is a really valuable way that safeguards our own check. Because if I can get $1 million of non-dilutive capital behind my check, then theoretically that's going to safeguard my investment with the investors. And the whole, kind of double negative of what would have happened or what wouldn't have happened. I'm afraid that I'm a little too practical to be able to think that one through. The good companies get funded, maybe not quite as fast for as high valuation, but I don't think there's an issue. It's really a question of a good company and a good entrepreneur doing the work, doing the homework, not being a high flyer. And I think Steve mentioned that he's very optimistic about the next 12 months, as am I. I think John was as well. There is money. There's money in the system. That money does need to go to work, and every good boy deserves favor.
John, you wanted to add this? Right. So, you're muted.
Oh, sorry.
There you go.
Thanks for allowing me to chime in. I mean, the good news is, in some ways, capital raising has always been difficult for startups in the middle of the country. It's no doubt about it. And VCs who do invest, like us and Scott and Drew, we all understand how difficult it is for them to raise capital. And a lot of times, the best thing that we can do is kind of work collaboratively. I mean, we syndicate every single deal. We're not a single check round writer, right, or single check writer for a whole round. So a lot of times you're working with at least 3 to 4 other VCs in every single round. And collectively, what we are doing is while we're investing in all these companies, we're also marketing them to all these firms that do have money. And we do that pretty effectively through the Advent conferences. I think Drew has attended a few of them, and we've hosted a few of these conferences all over the country. And the idea there is, again, we had to compensate for the lack of density, right? If you look at any one region, it's hard to find 30 startups that are raising Series A capital at any point of time. So if you are looking for Series A capital, a lot of times some of these conferences or investor meets could be a better way to kind of meet some of these coastal VCs, even if they're not, even if you're not currently invested, even if currently a VC has not invested in your company, some of these conferences could be a great way to find those potential investors, because that's one way you can go meet them in an open environment, in an open setting. And that's what we enable through OnMed, and that's one of the value adds that we create that is sustainable, and we can connect them to 150, 200 VCs at a time, and bringing 40 to 50 companies from all over the country to these conferences. And that could be scaled as well. And that is something that's repeatable for startup founders.
Thanks, John. So in the next 2 minutes, before we open it for Q&A, what are some of the most common deal breakers that you encounter when companies approach you for seed investment, or Scott, in your case, pre-seed? And what can companies do to increase the probability of being considered by your funds? Scott, why don't you get started?
Yeah, I mean, to me, the biggest deal breaker is that they are not generating venture scale outcomes even early, right? So somebody starts a company and it's 2 years and they've got no revenue at all. That's a deal breaker. People who show 15% increase in revenue from 1 year to the next, that's a deal breaker, right? So those kinds of issues are deal breakers. And then the other big deal breaker for us is just that people don't pay attention to what we're doing. So they ask us for the wrong thing, and we're just never going to do it. We're never doing a $25 million Series B. We're not going to lead that. That's bigger than our fund. Don't ask. And I can tell you that comes in once a week in my email.
That's interesting. So entrepreneurs got to do the research. Drew, how about you?
Scott hit a nerve on that one for sure. I mean, why people do it, either they're just mass sending things out or they're just tone deaf. But I mean, ask an investor for something that shows that you understand who they are and what their interests are. I mean, that's just sales 101, right? So I think that's really important. Relationships matter, even in our age of COVID and even our age of videos. You mentioned the statistic of historically angels or early seed investors were within miles of their companies. That's expanded a bit, but have a relationship with human beings. The other piece of data that I find highly compelling is that you are 1,000% more likely to get capital from sources than the proverbial VC you've never met. And so everyone should be using their Rolodex, both real and imagined. You should use LinkedIn. You should use your universities. You should use your friends. You should use your family. And you should start there, because if your family isn't willing to write a check, particularly those that can afford to, even if it's at a proportional amount of their wealth, if I'm coming in later and I have one more zero than them, why should I be writing that check also? So those are some of the things that occur to me that are easy things that are highly rectifiable for any entrepreneur to take care of, and don't take a lot of work.
And so, John, to close our discussion here, deal breakers.
I mean, Scott and Drew kind of covered the common ones that we experience as well. The one that's uncommon is probably, you encounter founders that don't or lack humility in terms of we're kind of know it all. We tend to stay away from founders. I think humility is one of those important things in the earlier stages that you'd want to see. And a team that is well-rounded also it also shows great leadership. And if you're humble, you will respect your team, you'll respect your team members, and you'll also want to grow your team and scale it. And that's what we have seen in the past as well. Like founders, like being young, a lot of times I think it's also a function of experience. I think once you are a little more experienced, you also tend to be a little more humble. And that also is probably one of those giveaways where people tend to feel like, hey, I can do this without any evidence, and that kind of shows through without that lack of humility. So I'll stop there. Let me know. I'm happy to take any questions, or I've seen a few questions as well on the chat. Happy to do any of those.
Yeah, awesome. So why don't we start with a yes no question? So you are so a question is, the panelists are focused on companies outside of New York, San Francisco, and Boston, and within the middle of the country. What about other areas such as Delaware, North Carolina, Florida, DC? Scott, those areas are fair game for you?
As long as companies are not exclusively all, by that we mean all the founders in San Francisco, Silicon Valley, New York City, and Boston, it's fair game. So like you name it, parts of North Carolina, parts of New Mexico, all that is fair game for us.
Awesome. How about you, John?
Same thing. We also include Canada to that as well. But in terms of the teams, as long as they're not headquartered in any of those cities, they're fair game. But we've had companies that have had sales offices or like offices in New York or San Francisco because they want to be closer to their customer. That's completely fine. But as long as the company itself is not headquartered, or all the founders are not located in San Francisco or Boston or New York, they're fine.
How about you, Drew? So New Mexico, right? And then how about outside?
Yeah, so our line is New Mexico company, New Mexican entrepreneur, or company that's going to make a difference for our state. So we try to stick to that thesis. We get attracted to other companies. But if you want to do business, come on down. It's a great state. We've got a lot of advantages.
Thanks, Drew. Okay, so last 5 minutes. So question is, would you each mind speaking to the steps you take along the thread of it takes the village to raise the child to help portfolio companies grow? How much more important is this philosophy compared to larger capital hubs? Scott.
So we think about it, use a different analogy. We think that we're kindergarten teachers. Our job is to get you to first grade. That means I don't teach you calculus. No kindergarten teacher has ever taught calculus. They don't worry about college applications, right? So don't worry about 6 stages down the road. So what we do is work on helping companies with all the things it takes to get to a seed round, or at the most remotest, Series A. Product market fit, introductions to the next round, investors, organizational structure issues if they haven't fixed those things ahead of time, completing a team if the team's incomplete. It's all the early stage stuff, not the other stuff.
John.
So in terms of, could you repeat the question? Sorry.
Yeah, of course. So would you mind speaking to the steps you take along the thread of it takes the village to raise the child to help portfolio companies grow? Yeah,
I mean, to continuing Scott's point, I think every stage it's different, right? So as early stage investors, we're prepping them to hand them off to later stage VCs. From a traditional VC model, we probably won't fit the mold from how, if you go read Power Law or whatever, any of those books where people are hand holding or taking sales meetings with founders. We're not doing that to a large extent, primarily also because having a middle of the country or outside of or non-thesis or sorry non-coastal region focus, we can't be in those locations. Like we have startups in 26 different states. We have less than 10% of those startups in Colorado. And even the startups in Colorado are kind of widely dispersed. So we're not like a bicycle right away, like most VCs in San Francisco. So we don't adhere to that model. So from a traditional VC standpoint, a lot of people would be like, hey, you guys are not even VCs. And I'd be like, yeah, maybe not, right? So, what this is creating is probably a new asset class. I don't know what you want to call it, but we're probably getting grouped into the VC venture capital asset class. But I feel like investing in a distributed portfolio where most of things that you're doing is preparing them for the next stage. And a lot of times it's very general things, right? Helping them fundraise, helping them with the right talent, helping them with things that you can do remotely is what we are trying to do from a VC standpoint. And that's something that is kind of different than your traditional VC model.
So we're out of time. So Scott, do you want to add something on?
Yeah, I just want to add a particular point about a dirty little secret about venture, which is that venture capitalists make most of their money on the companies they help the least, because the companies themselves do the performance and they're really good. And I wrote my first check into an early stage company in 1998. I can tell you that this is true from my own bank account. And it's psychologically extraordinarily difficult that the people who need the most help, it's not a good use of your time to give it to them. The people who don't need any help and making you all this money and you feel guilty for it.
100% right.
Drew, anything to add?
No, just closing. Thanks everyone. Thanks everyone who
Awesome.
participated in this. All three of us, I think, are tried and true in terms of wanting to see the greater whole be better. And I think the people that I've met who are sincere about this care and are reachable and communicative and are available. So our emails are in the chat. I'm sure that our organizers will make our bios and stuff available. Be in touch.
Yes.
Do the things that are available to the things. Follow the things that we shared here today. And let's all get together and help great companies grow, because there's nothing better both for a human being, for the world, and also just for the feeling of seeing the success of these startups. And I think that's why we're all here. So thank you for the opportunity to share today.
Yeah, of course. Yeah, so context there. I want to thank you all for sharing your thoughts with our audience. And I just want to remind everyone the panelists being recorded is going to be posted in the Marion Street Capital website. And stay connected for upcoming huddles for Marion Street Capital.